Greetings, everybody. Welcome to Liberty Call. Today is Friday, June 9th, 2023. Hope everybody's having a good day out there in the interwebs. Little overcast again here in Colorado. Looks like we got some more storms coming our way, which I'm not going to complain. I got pollen all over my truck. It's disgusting. But, and I mean, I could wash it, but then, there'll be more pollen on it tomorrow. So there's really no point right now. So anyways, if it's your first time watching Liberty Call, I'm glad you're here. Thanks for being here. Please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. I would greatly appreciate it. And let's go ahead and jump into the markets. Kind of a meh day. I think, supposedly we're now in this bull market, according to some statistics from yesterday. I haven't read through those articles to see what they're looking at, but we shall see. All right, starting out with the Dow Jones, it was up 0.13%, 43 points, closed at 33,877. The S&P 500 was up 0.17%, closed at 4301. NASDAQ was up 0.16%, closed at 13,259. Let's see here. The VIX was up today, 1.83%. It's currently at 1389. Canada was down 0.25%. Brazil was up 1.32%. Mexico up 0.28%. Going over to Europe, Germany was down 0.25%. UK down 0.49%. Let's see here. France down 0.12%. Netherlands down 0.21%. Spain down 0.31%. Italy down 0.41%. Switzerland down 0.48%. And Portugal up 0.22%. So the lone bright spot in Western Europe was Portugal for some strange reason. All right. Russian exchanges both in the red today, barely. The MOEX down 0.06. The RTSI down 0.05. And the overnights in Asia, starting out with the Nikkei in Japan, it was up 1.97%. Australia was up 0.32%. New Zealand was up 0.12%. In China, the Shanghai was up 0.55%. The Shenzhen Component up 0.66%. China A50 up 0.28%. DJ Shanghai up 0.51%. Hang Seng up 0.47%. And the Taiwan weighted was up 0.91% for the day. So it looks like the Asian markets did pretty well overnight, but things seemed to deteriorate. And then, we were kind of more along the flat line here domestically. Actually, let me bring up the chart. We can look at today's, bring it up. All right, here's the S&P 500. You can see today's numbers. It was, kind of up, but not a whole lot. I think at its peak, it was up about 1/3% for the S&P 500. The Dow Jones started the day out in the red. Actually, it started out in the green, then went into the red, and then finished the day off, about halfway between the high and the low. Let's look at the NASDAQ while we're here. Same thing, opened up real high and then fell and then kind of finished in between the 2 points. All right, well, let's go ahead and look at the week here. All righty. Starting out with, let's start with the S&P 500. For the week, it is going to finish off, looks like up about 0.4%. The Dow Jones, it's going to finish off about a third, 0.33% up. NASDAQ, actually, it looks like it's going to be about pretty much flat, down 0.06. The Dow Utilities, going to finish up about 1.6%. And the transports, where are we? Looks like it's up about 1.23%. So, not a terrible week, but let's take and zoom out from, let's go to the daily chart and take a look and see, this trend we've been in since the beginning of 22. We've been in this downtrend, and really since January, February timeframe, we've been just in this sideways market. So maybe because it broke above this previous high, that's why they're saying it's a bull market. But again, I need to go and read the articles and see what sort of evidence they're saying. I mean, because looking at the big picture, I certainly don't think things are excellent right now. So, but hey, I could be wrong. It is what it is. All right, let's go ahead and jump into the economic data for the week. Initial jobless claims came in at 261,000. Forecast was 235. Last week's number was 233. So again, still not terrible. Let me zoom in a little bit. This is the last 2 years. I mean, we've kind of been in these cycles where it kind of ups and downs, but it really hasn't gotten above that 250 number too consistently. So, and definitely haven't broke 300,000 in quite a while. So, but all in all, not too terrible. Continuing jobless claims came in at 1.757 million. Forecast was 1.8. Last week's number was 1.794. So dropped off about 40,000 there. And again, looking at zoom in on the 2-year, still nothing too, we haven't gone over 2 million since, was that September of 21? So almost 2 years. So again, it's not too bad. So about right in this range is where we were, I guess right around here. We were the last time we were above 3 million people unemployed. So, all right. Jumping on over to factory orders month over month, came in at a 0.4% growth. Forecast was 0.8. Last month's number was a 0.6. The Services Purchasing Managers Index came in at a 54.9. Forecast was 55.1, so just a hair under forecast. Last month's number was a 53.6. So that was all the economic data that was on the docket for this week. Let's go ahead and jump over to the market recap. S&P 500 gives up some gains, but tech strength keeps bulls in control. The S&P 500 experienced a reversal in gains on Friday after entering a new bull market the previous day. However, the index continued to be supported by the climb in big tech stocks and a boost from consumer stocks led by Tesla. Tesla's stock surged over 3% as investors celebrated news of its partnership with General Motors, which allows GM vehicle drivers to access Tesla's EV charging network. Wedbush analysts highlighted the collaboration as a significant monetization opportunity for Tesla's supercharger business, adding to the company's overall valuation. Both GM and Ford also saw their stocks rise following their own agreements to access Tesla's superchargers. In addition, to the positive news from the EV sector, big tech companies continued their upward momentum, benefiting from the optimistic outlook on artificial intelligence. The market believes that tech giants have the financial resources and regulatory compliance capabilities to capitalize on emerging AI industry. Goldman Sachs emphasized the ability of larger tech companies to bear the costs of building large language models, managing computing expenses, and meet regulatory requirements. Adobe saw its stock price rise ahead of its upcoming quarterly results, driven by Wells Fargo's upgrade of the stock to overweight from buy. The upgrade was influenced by optimism regarding Adobe's progress in AI and its potential to drive growth. On the other hand, DocuSign experienced a decline of over 3% despite better than expected quarterly results. CEO Alan Thygesson's cautious remarks about the slowing growth and a cautious consumer backdrop overshadowed the positive earnings report. Braze enjoyed a significant rally of 16% following better than expected quarterly results, prompting positive commentary from Goldman Sachs. The investment bank reiterated its buy rating on the stock, highlighting the potential of AI-driven market share gains. Overall, the S&P 500 retreated slightly. The ongoing climb in big tech stocks, Tesla's impressive winning streak, and positive developments in the EV and AI sectors provided support for the market today. All right, so everyone's rosy and happy right now. Ooh, we're in a new bull market. Let's throw all our cash in and see what happens. Could be dangerous. All right, next up comes from Zero Hedge. It's titled The End of Easy Money. Bankruptcy filings pile up at the fastest rate since 2010. It's written by Wolf Richter of wolfstreet.com. And get my summary up here. This year is shaping up to be a more significant one for corporate bankruptcy filing, signaling the end of an era characterized by easy money and yield-chasing investors. During the peak of the Federal Reserve's yield repression in mid-2021, even junk-rated companies with excessive debt and insufficient cash flows could borrow at around 3%. However, as interest rates have risen, these companies now face the challenge of refinancing or adding new debt at yields nearing 7%, putting significant strain on their financial position. Consequently, many over-indebted junk-rated companies are resorting to restructuring their debts in bankruptcy court, shifting the burden away from stockholders, bondholders, and leveraged loan holders. S&P 500 Global's May bankruptcy statistics revealed that 54 publicly traded companies with at least $2 million in assets or liabilities filed for bankruptcy, bringing the total for the first 5 months of the year to 286 filings. This figure surpasses the filings for the same period in 2022 and 2020, indicating a growing trend. The bankruptcy filings include notable companies such as Envision Healthcare, Vice Holdings, Vice Media, Kitty Fernwall, and Monotronics International. This surge in bankruptcies has marked the highest level since 2010, with 402 companies filing for bankruptcy during the first 5 months of that year. The increasing number of filings reflected the end of easy money and the rising cost of debt, prompting investors to exercise more caution. I don't feel bad about Monotronics. My wife worked for them years back and they were assholes. Unlike previous economic downturns caused by collapsing prices or a decline in demand, the current problem lies in the higher costs of debt and investors' decreased willingness to invest in such debt. The end of easy money has exposed companies that relied heavily on debt, making it difficult for them to sustain their operations without easy access to capital. Bankruptcy filings are expected to reduce the corporate debt burden, allowing companies to emerge with less debt and increased agility. Some companies may be sold off in parts, making room for better managed entities that are not burdened by excessive debt. This cleansing process, long overdue, will eliminate excesses and inefficient businesses, ultimately benefiting the overall economy. Ironically, the end of easy money is now being referred to as a credit crunch, a term that highlights the shift in the financial landscape. While Wall Street may clamor for rate cuts, this phase of the credit cycle serves as a necessary corrective measure to address the excesses of past and promote healthier financial practices. Yeah, it's kind of like when you go through like a major market downturn, like we did in 2009 and 10. It flushes out all the malinvestment in the system, so the companies that were sort of operating, and especially these days with you're getting a lot of cheap credit, and you can just continue. Continue to borrow and borrow and borrow. It makes it look like the company is doing all right, but then. When the tide goes out, you really see who's standing around without any trunks on. So anyways, all right. One last thing here. I got a video for you. It comes from Malden Economics. The title is 4 Addictions, a Framework for Understanding the Global Shifts in 2023 with Bruce Mehlman. So let's go ahead and bring this up on the screen. And we'll go ahead and listen to a couple of minutes of this. Video is linked in the show notes. So I would recommend, watching the whole thing. It's about 30 minutes, I believe. Yeah, 30.24 minutes. So, you can watch it at your own leisure, but they always have good stuff on their weekly videos. This is one that's actually from last week. I had too much other stuff to cover last week, so I didn't cover it then. So let's go ahead and watch.
Sort of slow realization that there's a new normal now. And you did a great job with your latest slide deck of crystallizing what changed, why we're in this new inflationary environment that's going to be with us for a long time. And you highlight 4 addictions, the 4 addictions of the United States that need to be addressed in order for the country to move forward. Can you walk us through those 4 addictions, just top level, and then we'll kind of dig into each one individually?
You bet, Ed, and thanks so much for both having me at the conference, but also having me back here on your great program, which I religiously watch. The macro theory is that it more looks at this century, and it looks at the first 2 decades of this century, when we became increasingly reliant on China, on digital technologies, on easy money, which, low interest rates from the Fed, quantitative easing, and on debt, on spending beyond our means. And this is certainly the United States, but it's frankly true all around the world. And what I observe is that those 4 dependencies grew and have become unsustainable, in part accelerated. The negative externalities got accelerated through COVID, through the Russian invasion of Ukraine, through just broader changes, whether demographics or climate. And we've now reached a point of unsustainability. Our dependence on China, which I'm sure we'll talk about in a minute, is now dangerously unsustainable. Same with technology, which is overwhelmingly net positive, but the lack of any controls creates more risk than we want. Inflation proves we can no longer rely on easy money as a solution to difficult problems. And likewise, we'll see how long we can continue to pile debt on top of debt. It feels unsustainable, but to be fair, I've been saying that for decades.
Yeah, a lot of us have. Though it seems like, maybe we could just start with debt, because just the fact that it's starting to be discussed.
All right, we'll go ahead and stop that there. A little bit of a tease for everyone out there. So I would recommend going and watching that on your own time. So, but some of the same things that I complain about on a regular basis: too much debt and too much spending, and easy credit and all those sorts of problems. The government experiences the same problems that families do, and these are the same things I harp on. And getting your financial house in order is probably the best thing to do. But hey. our government would rather spend our money, or well, it's not even our money. I mean, they're spending debt. They're really not even spending the money that we pay. Well, about half of it is tax money, and the rest is just accumulated debt that they continue to charge up the credit card. So all bad things, in my opinion. But anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastical weekend. Go out and have some fun, get some sun, get some exercise, maybe do some chores. I got some weeding I need to do here. I trimmed the yard, I guess it'll be 2 weeks on Monday. And, with all this rain, it's just gotten completely overgrown again. So, oh, well, so it looks like I have a date with the weed whacker and, some other stuff. So again, hope everyone has a fantastic weekend. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a terrific weekend, and I'll talk to you next time. Adios.